Hi, my name is Michael DeStasio, the founder of Valor Advisors. Valor Advisors specializes in helping police officers and firefighters reach their investment, tax, and retirement goals. Today, we're going to learn how to prioritize between the different retirement and investment accounts for first responders. Also, we will look at when should I contribute to a 401k, 403b, or 457b, IRAs, and taxable accounts. Plus, what are the trade offs between each account?
Before I begin, don't forget to subscribe to our channel and like the video to help us reach more first responders.
So, first off, which retirement and investment accounts should I contribute to first? This is a common question I hear from many first responders because of all the different account choices and the varying rules and tax rules surrounding them. So, this can depend on many factors, such as how much money you can save each year, the income tax bracket you are in right now, the income tax bracket you will be in at retirement, which can be considerably different from the one you are in today, how much money is already saved up. That's also important to know. How many years are left until retirement and when will you need the money? The taxability of your future income streams. Believe it or not, different types of income streams have different tax consequences. Any goals with specific timelines. Those all have very important factors into the types of investment accounts you use. Next, let's look at retirement and investment account definitions and tax details. First, we will look at the difference between pre-tax or traditional. That means contributions are income tax deductible annually on your tax return. Later on, you will pay income taxes when you withdraw the money. Each year, you do get a tax deduction on your income taxes. Later on, when you go to withdraw the money, you will pay income taxes. While the money is growing, you will not pay any capital gains tax. Plus, the money also gets to grow tax-free from dividends or interest. Next is post-tax or Roth accounts. What that means is any contributions are not income tax deductible. So essentially, the year you put the money in, you get no deduction on your taxes. However, the money is tax-free for life. So to recap that, right, no tax deduction. But when you withdraw the money, you don't have to pay any taxes at all. Furthermore, while the money is growing, you do not pay any capital gains tax, nor will you pay any taxes on the dividends or interest. The Roth account is one of the most powerful and tax-advantaged retirement accounts there is. Now let's look at taxable accounts. For taxable accounts, you do not get an income tax deduction when you place money into the account. Each year, you must report the capital gains, the interest, and any dividends received on your income tax return annually. To recap, right? No tax deduction for putting the money into the account. You technically do not pay any income taxes when you withdraw the money. However, you will pay a capital gains tax when you sell an asset for a profit. You will pay taxes on the dividends or the interest that are earned from the investments. This all gets reported on your tax return every single year and is most commonly accomplished by the 1099 that your custodian or broker will send to you. Now, let's look at a general approach to which accounts you should use first. This is without analyzing any specific situation. So, for most people, you might want to start with your workplace retirement plan. The reason is it allows the highest annual contribution amount. Next, you might want to look at your IRA. IRAs are a versatile tax advantage tool that offer greater control and options with your investments. Last is a taxable account. Since this gives you instant access to cash, but no specific income tax advantages, it should be the third one you look at. Now let's take a look at a young first responder family who is looking to buy their first home. With that goal in mind, they might want to approach things a little bit differently. First, they actually might want to look at a Roth IRA. Reason being, the Roth IRA can provide a liquidity option for their home buying goal within a few years. Next, they want to look at a taxable account. Reason being, as a young family, they may need access to additional cash for their down payment or for any emergencies that pop up as a result of having kids. Lastly, they want to look at their pre-tax 457B. Since they're most likely in a low tax bracket early on in their careers, it makes it the least attractive option when prioritizing the other goals. In our second example, let's look at a first responder near retirement. In this scenario, they're majority invested in a pre-tax 457B. So let's look at how they should prioritize the different investment accounts. First, they might want to consider a Roth 457B. And they also will want to utilize any catch-up contributions to stash away extra tax-free dollars. The reason why this is important is because they're currently heavily invested in their pre-tax 457B, and considering that they'll have a pension later on, it could create a compounding tax effect. So you might want to check with your employer if they offer a Roth 457B, as it's a very powerful tool. Next is a taxable or HSA account. HSA stands for Health Savings Account. These accounts will be helpful if you have an extra need for cash, for example, if you want to relocate, or to help you with your medical expenses, which is specifically what the HSA account is for. Based on those needs, you might want to prioritize those accounts next. Lastly, would be a traditional IRA. Since they're likely in a higher income tax bracket and IRA contributions are not tax deductible anyway, this would be their third choice. They may even want to consider doing Roth conversions later on, but before you do that, you should definitely consult a professional to help you through that process and see if it's good for your situation. Next, let's look at workplace retirement plans, the pros and cons between them. First is workplace plans offer the largest annual contribution out of all the investment accounts. Second is they also offer higher catch-up contributions if you're aged 50 plus. There are two separate catch-up contribution limits for workplace plans and IRAs. And IRAs have a smaller catch-up contribution limit, just set by law. They may allow plan loans. And this is employer specific, so you need to check with your employer first. And why that's important is because if you need a source of liquidity in a pinch, you could potentially borrow some money from the workplace plan. There are also special separation from service rules. These rules apply only to federal, state, and local law enforcement officers and firefighters. This is helpful because you might be retiring early, such as at age 50, and you might need money at that point. So there are specific rules exempting you from any early distribution penalties. So definitely check with a qualified professional if this is something that is helpful to you in your situation. Now, some cons. One is there are limited investment options. Most workplace plans offer 25 to 30 choices, and maybe only a couple are really useful for you based on your needs and goals. Another con is you might have limits on how often you buy or sell funds. Now, in practice, this is a thing that's designed to help people from day trading or trading their retirement plans. But based on a specific situation, it could end up hindering you. Let's look at individual retirement accounts next. Here are some of the pros. IRAs offer substantially more investment options. This can include individual stocks, precious metals, things like peer-to-peer lending, even real estate. Okay, so there are just many more options. They can be used for qualified educational expenses. So this can be very important if you have goals for your children. The funds can also be used for a first-time home purchase. Once again, really great to use if you have a specific home buying goal. Now for some cons. There are lower contribution limits. As a general rule, the IRS does not allow you to put as much money into IRAs as they do workplace plans. You cannot borrow from an IRA, ever. It's just simply not allowed. Now for taxable investment accounts. Let's look at some of the pros. There are unlimited investment options with a taxable investment account. Literally just about anything you could think of, you can invest in through a taxable investment account. Also allows you quick access to your money with no worries about penalties or anything like that. You can sell the asset and within a few days have it back in your bank account. There are no restrictions on fund use. Simply put, you can use the money for whatever you want. Unlimited contributions. You can put as much money as you desire every single year into your taxable investment account. It does not matter how much or how little you make or how much you have. So if you can save a lot of money, it's a very useful tool. Lastly, you do not need earned income to contribute as you do with IRAs or workplace plans. A lot of people do not know this. So you don't have to have a W-2 job in order to contribute to a taxable investment account. With IRAs or workplace plans, you definitely have to have earned income per the IRS guidelines. As you said, right, not a need for taxable investment accounts. So depending, no matter your situation, you can likely get money into one of these accounts. Now for some of the cons. You will need to be strategic when you sell assets due to the tax consequences. Remember, every year you have tax reporting requirements for the gains, losses, the dividends, and the interest earned. So if there is a very large gain or a very large loss, you could potentially make a tax mistake, and you don't want to do that. So consult with a professional there. As I mentioned, you must report the gains and losses on your tax return every single year. Now for a summary. When determining which investment accounts to use, proper planning can help you create a tax-efficient plan. Tailoring contributions to your specific needs will help grow your assets faster and saves you thousands of dollars by minimizing mistakes. If you'd like help with anything I talked about today, or to start your own customized retirement plan, then reach out by visiting valoradvisors.com or send me an email, michael@valoradvisors.com. I hope you found this information helpful and informative. Have a great day.